Hey everyone, and welcome to This Explainer. Today, we're going to unpack the completely invisible mechanics behind the money sitting in your pocket right now. Seriously, have you ever stopped to think about what actually gives our entire financial system its power? Well, today we are breaking down the whole shebang, the history, the mechanics, and the wild future of how we humans exchange value.
But before we get into the weeds, let me ask you a question that really gets to the very heart of human economics. Why on earth is a useless piece of printed paper worth a whole sack of wheat? Or a brand new pair of shoes, for that matter? Think about it. If you were stranded on a desert island, that paper note wouldn't keep you warm, and you certainly couldn't eat it. Literally useless. Yet in our society, it's the ultimate key to survival and comfort. So, how exactly did we get here?
All right, here's our roadmap for today. We're going to quickly cover the problem with barter, the evolution of money, how modern currency and the RBI work, demand deposits and checks, how banks actually make their money, and finally, this massive shift to digital that we're all living through.
Okay, kicking things off with part 1, the problem with barter.
To really understand why money even exists, you gotta put yourself in the shoes of someone dealing with the massive headache that came before it. Imagine a world where every single purchase was this complex, exhausting negotiation of physical goods. Let's say you're a shoe manufacturer, right? And you want some wheat, but the wheat farmer you find only wants clothes. He doesn't need your shoes. Your needs don't perfectly align, so trade just comes to a complete standstill. You'd have to wander around the market hoping to find someone who both has clothes to trade for your shoes and actually wants to trade those clothes for wheat. It is incredibly mind-numbingly inefficient.
Economists actually have a name for this agonizing friction. It's called the double coincidence of wants, and it makes direct trading so difficult. For a pure barter system to work, what you want to sell must be exactly what the other person wishes to buy at that exact moment. Without this perfect, almost magical coincidence, economic progress is essentially frozen in its tracks.
Which brings us nicely to part 2. The evolution of money.
Humanity obviously desperately needed a workaround. We needed a universal medium of exchange. If we look back across history, early Indians used super practical items like grains and cattle as money. But, as you can guess, because cattle age and grains rot, and they're a huge pain to transport, we eventually evolved to using precious metals and then ultimately the paper and modern coins we use today.
Just think about one of the absolute earliest solutions to that barter problem. We're talking about ancient punch-marked coins from roughly 2,500 years ago. This was a monumental shift in human thought, you guys. People finally agreed that a small, standardized piece of metal held a recognized value, making trade infinitely easier than swapping cows.
Fast forward a bit, and beautifully crafted metallic coins became the gold standard, literally. Take a stunning gold mohar from Akbar's reign, for example. These coins were made of gold, silver, or copper, metals that actually possess their own intrinsic value. But as economies exploded in size, carrying around heavy bags of precious metals became completely impractical, which paved the way for modern paper currency.
Now for part 3, modern currency and why it actually works. So, unlike gold or silver, modern currency has absolutely no intrinsic use. Like we said earlier, you can't eat it, you can't build a house out of it. So why does it work? Well, it relies entirely on trust and authority. In India, the Reserve Bank issues currency on behalf of the central government, officially making the rupee a legal medium of payment. Because no individual in the country can legally refuse it to settle a transaction, everyone just inherently trusts its value. It's a shared belief system.
Moving on to part 4, demand deposits and checks.
Let's be real, carrying piles of paper cash around is super risky and honestly, pretty inconvenient. So let's look at a practical example of how we solve that. Instead of lugging around a briefcase of cash, a shoe manufacturer named M. Salim can simply write a check to his leather supplier for, say, 57,000 rupees. Salim's actual physical cash stays completely safe in the bag, quietly earning interest.
Now, because people can withdraw these funds on demand whenever they want, they're called demand deposits. And here's the cool part. These demand deposits act exactly like money. When Salim hands his supplier that piece of paper, he is officially instructing his bank to transfer the funds. The supplier deposits it, the banks talk to each other, and boom, the transaction is settled in a couple of days seamlessly without a single physical rupee ever changing hands. Which brings us to part 5, and this is a fun one: how banks actually make money.
Have you ever wondered what actually happens to the money you leave in the bank? It doesn't just sit in a giant vault gathering dust, Scrooge McDuck style. Prepare to be a little surprised. Banks in India typically hold only about 5% of their total deposits as actual physical cash on any given day. Since not everyone rushes to withdraw all their cash on the exact same day, this 5% provision is generally totally fine to keep daily operations running smoothly.
So, where on earth is the other 95%? Well, the rest acts as a massive economic engine. The bank steps in to mediate between those with surplus funds, that's the depositors, and those who desperately need funds to grow businesses or buy homes, the borrowers. The bank pays you a certain interest rate for keeping your deposits with them, sure, but they charge a much higher interest rate to the people taking out loans. That difference in interest rates, that spread, is the bank's main source of income. It's literally what keeps the entire banking ecosystem alive and thriving.
And finally, Part 6, the massive shift to digital.
Let's talk about the rapid, almost overnight leap away from physical cash entirely. This transition was vastly accelerated in India by huge policies like the 2016 demonetization, where older notes were abruptly declared invalid. Following that shock to the system, the public was heavily encouraged to use bank deposits over cash. Suddenly, plastic debit and credit cards became an everyday sight for average citizens, helping to rapidly formalize the whole economy. And that brings us to the absolute cutting edge of our daily financial lives, the humble QR code. It's almost magic. By simply pointing a smartphone camera at a pixelated square, money instantly moves from one bank account to another through systems like UPI. No cash, no cards, no waiting.
I mean, just take a second to look at how far we've actually come. From the agonizing frustration of the barter system, to hauling around heavy sacks of metal coins, to paper notes, we have officially arrived at a world of instant, cashless transfers. These digital tools don't just make our lives incredibly convenient, they streamline global trade, they create totally transparent digital records, and they really help clamp down on corruption.
Which leaves us with one final, kind of mind-bending thought to ponder about the future of our wallets. If money has evolved from cows to gold to paper and is now literally just a digital record flashing on a bank server somewhere today, what in the world is going to be our medium of exchange tomorrow? Thank you so much for joining me on this explainer. Keep asking those big questions, and I'll catch you on the next one.